Welcome, everyone. Today we're diving into the fiat monetary system. From buying groceries to global trade, the fiat system plays a pivotal role. Understanding its mechanics is crucial for navigating our economic landscape. We'll demystify jargon and use real-world examples to illustrate key points. So buckle up as we delve into the fascinating world of fiat money. At the heart of the fiat system lies a simple concept. Money itself doesn't have inherent value. Modern currency isn't backed by a tangible commodity, but by government decree. This system relies heavily on trust in the issuing government and economic stability. The value of fiat money is a social construct, functioning as long as people have confidence in it. Understanding these vulnerabilities is key to grasping the full implications of the fiat system. To understand fiat money, we need to journey back to the gold standard era. The gold standard provided stability but limited economic flexibility. World War I marked a turning point, leading to the emergence of fiat money. The period between the world wars saw a fragmented monetary landscape. The Bretton Woods system aimed to rebuild the international economy. The US dollar became the world's reserve currency, pegged to gold. However, the growing economic power of other nations strained this system. The Bretton Woods system faced inherent contradictions. The US faced economic challenges in the 1960s, leading to the Nixon shock in 1971. The US dollar was no longer convertible to gold, marking a shift to a global fiat system. This move ushered in an era of floating exchange rates. The Nixon shock marked a profound shift in the global monetary order. Nations could now pursue independent monetary policies. This brought opportunities and risks, including inflation and currency manipulation. Central banks took on a more prominent role in managing the fiat system. Central banks are key players in managing the fiat system. They use tools like interest rates and reserve requirements to influence the economy. Their goal is to maintain stability, promote growth, and control inflation. Central banks control the money supply and set interest rates. Increasing the money supply can stimulate economic activity, while reducing it can curb inflation. Lowering interest rates encourages borrowing and investment, while raising them can slow inflation. The challenge is finding the optimal balance. Fractional reserve banking plays a significant role in money creation. Banks hold a fraction of deposits in reserve and lend out the rest. This cycle of lending and depositing increases the money supply. Central banks regulate this system to prevent excessive money creation and inflation. Understanding this system is essential for comprehending the dynamics of money creation. The fiat monetary system is inherently global. Exchange rates fluctuate, impacting international trade and investments. Central banks often coordinate policies to maintain stability. Understanding the interconnectedness of the global fiat system is crucial for navigating international finance.
While the fiat monetary system has its critics, it's important to acknowledge its advantages, particularly when compared to its predecessor, the gold standard. One of the most significant benefits is its flexibility. Unlike the gold standard, which tethered economic growth to the availability of physical gold, fiat money allows governments and central banks to adjust monetary policy in response to changing economic conditions. This flexibility empowers governments to stimulate economic activity during recessions or periods of slow growth. By increasing the money supply, lowering interest rates, or injecting liquidity into financial markets, central banks can encourage borrowing, investment and spending, potentially mitigating economic downturns. Furthermore, the FIAT system provides governments with tools to manage inflation, albeit with varying degrees of success. By controlling the money supply and influencing interest rates, central banks aim to keep inflation at a moderate level, preserving the purchasing power of the currency and maintaining economic stability. The ability to manage the money supply also allows governments to fund social programs, invest in infrastructure and respond to crises, flexibility that wouldn't be possible under a rigid gold standard. The fiat system, in essence, provides policymakers with a broader set of tools to influence economic outcomes, potentially smoothing out the boom and bust cycles that characterized earlier monetary systems. However, this flexibility comes with its own set of challenges. The power to manipulate the money supply also creates the potential for mismanagement, inflation, and the erosion of purchasing power if not handled responsibly. The history of fiat currencies is replete with examples of both prudent management and disastrous policy decisions, highlighting the importance of sound economic stewardship. One of the most persistent criticisms leveled at the fiat monetary system is its inherent susceptibility to inflation. Unlike gold, which has intrinsic value, fiat money is essentially a promise to pay, backed by the credibility and stability of the issuing government. When governments print excessive amounts of money, or when the money supply grows significantly faster than the economy's ability to absorb it, the value of the currency can erode. This erosion manifests as inflation, a general increase in the prices of goods and services, reducing the purchasing power of consumers. Moderate inflation is generally considered a natural part of a healthy economy, reflecting growth and increased demand. However, high or hyperinflation can be devastating, wiping out savings, eroding purchasing power, and destabilizing entire economies. The challenge for policymakers operating within a fiat system is to strike a delicate balance, promoting economic growth without triggering runaway inflation. This requires careful management of the money supply, prudent fiscal policy, and a deep understanding of the complex interplay between monetary policy, inflation, and economic activity. Central banks play a critical role in this balancing act, using their tools to control inflation while also fostering economic growth. However, the effectiveness of their policies can be influenced by a myriad of factors, including global economic conditions, geopolitical events, and unforeseen crises, making inflation management an ongoing challenge in a fiat-based world. Another significant criticism of the fiat monetary system is its tendency to encourage debt accumulation and potentially fuel asset bubbles. Because central banks can create money electronically, essentially out of thin air, it can lead to a culture of easy credit and excessive borrowing. When interest rates are low, as they often are in a fiat system seeking to stimulate growth, borrowing becomes more attractive for individuals, businesses, and governments alike. This can lead to a build-up of debt, both public and private, which can create systemic risks if not managed prudently. Excessive debt levels can make economies more vulnerable to economic shocks. When debt burdens become unsustainable, it can lead to a credit crunch, defaults, and a contraction in lending, potentially triggering a recession or financial crisis. Moreover, the availability of easy credit, coupled with a desire for higher returns, can fuel asset bubbles. When asset prices rise rapidly, driven by speculation and leverage rather than underlying fundamentals, it can create a disconnect from the real economy. These bubbles, when they burst, as they inevitably do, can have severe consequences, as witnessed during the 2008 financial crisis, triggered by a housing bubble. The challenge for policymakers is to find the right balance, encouraging sufficient credit creation to support economic growth without fueling excessive debt accumulation or asset bubbles. This requires a delicate touch, careful regulation of financial markets, and a willingness to address unsustainable debt levels before they morph into systemic risks. Section 4. The future of fiat challenges and potential alternatives. As we navigate the complexities of the 21st century, the FIAT monetary system faces a confluence of challenges that raise questions about its long-term sustainability. The rise of cryptocurrencies, the increasing digitization of finance, and the lingering after-effects of past financial crises have prompted a re-evaluation of traditional monetary systems. One of the most pressing concerns is the potential for currency wars, competitive devaluations where countries intentionally weaken their currencies to gain a trade advantage. This can lead to protectionist policies, trade tensions, and a destabilization of the global financial system. The increasing interconnectedness of the global economy also makes the FIAT system more susceptible to cross-border shocks. A financial crisis in one country can quickly spread to others, as witnessed during the 2008 meltdown and the more recent European sovereign debt crisis. Moreover, the rise of cryptocurrencies, such as Bitcoin and Ethereum, while still in its early stages, poses a potential challenge to the dominance of fiat currencies. These decentralized digital currencies operate outside the control of governments and central banks, offering an alternative to traditional monetary systems. Whether cryptocurrencies will eventually replace or coexist alongside fiat currencies remains to be seen. However, their emergence highlights the evolving nature of money in the digital age and the potential for innovation to disrupt traditional financial systems. The future of fiat is likely to be shaped by how effectively it adapts to these challenges, maintains public trust, and navigates the evolving landscape of global finance.
Section 1. The Weimar Republic, a cautionary tale of hyperinflation. The history of fiat currencies is replete with examples of both prudent management and disastrous policy decisions. Perhaps the most infamous case of fiat currency failure is the hyperinflation that gripped the Weimar Republic Germany in the early 1920s. This episode serves as a stark reminder of the importance of sound monetary policy and the devastating consequences of its failure. Following World War I, the Weimar Republic faced crippling war reparations imposed by the victorious Allied powers. To meet these obligations, the German government resorted to printing massive amounts of paper money, rapidly increasing the money supply. This excessive money printing, coupled with a decline in economic output and a loss of confidence in the currency, triggered a hyperinflationary spiral. Prices soared at an astronomical rate, wiping out savings, eroding purchasing power, and plunging the German economy into chaos. At the height of the hyperinflation, the exchange rate between the German mark and the US dollar reached an unfathomable level. In 1914, one US dollar could buy roughly 4 German marks. By November 1923, it took 4.2 trillion marks to buy a single US dollar. The social and economic consequences of the hyperinflation were devastating. People lost their life savings, businesses collapsed, and widespread poverty and unemployment gripped the nation. The hyperinflation also contributed to political instability, paving the way for the rise of extremism and ultimately the Nazi Party's ascent to power. The Weimar Republic's hyperinflation serves as a cautionary tale, illustrating the dangers of unchecked money printing, excessive debt, and a loss of confidence in a nation's currency. It underscores the importance of sound monetary policy, fiscal discipline, and a commitment to maintaining the stability of a fiat-based system. Section 2. The US dollar, from gold backing to global reserve currency. The US dollar contrasts with the Weimar Republic's hyperinflation. Despite leaving the gold standard in 1971, the US dollar remains the dominant reserve currency. Post-World War II, the Bretton Woods Agreement anchored the dollar in the global monetary system. Even after Bretton Woods collapsed, the dollar retained its dominance. The US economy's size, liquidity, and stability contribute to the dollar's appeal. Central banks hold trillions in dollars to stabilize currencies and manage debt. This demand allows the US to borrow at lower rates. However, alternative currencies like the euro and yuan could challenge the dollar. Venezuela's struggles, a modern hyperinflationary crisis. While the Weimar Republic's hyperinflation might seem like a distant historical event, the devastating consequences of uncontrolled money printing are still being felt in countries like Venezuela today. Once a prosperous nation with vast oil reserves, Venezuela has been mired in an economic crisis marked by hyperinflation, shortages and social unrest. Voice 1, Roxana's voice, Venezuela's economic woes stem from a combination of factors, including government mismanagement, corruption, price controls, and a decline in oil production. To finance its growing budget deficits, the Venezuelan government resorted to printing money on a massive scale, fueling a hyperinflationary spiral. As the money supply surged, the value of the Venezuelan bolivar plummeted, leading to hyperinflation that reached an estimated 1.3 million% in 2018. Prices for basic goods and services became exorbitantly expensive, wiping out savings, eroding purchasing power, and plunging millions into poverty. The hyperinflation has had devastating consequences for the Venezuelan people. Shortages of food, medicine, and other essential goods have become commonplace, leading to malnutrition, disease outbreaks, and a humanitarian crisis. Millions have fled the country in search of a better life, creating a refugee crisis in neighboring countries. Venezuela's experience serves as a stark reminder that hyperinflation is not merely a historical anomaly, but a very real threat in the modern fiat-based system. It highlights the importance of sound economic policies, responsible governance, and a commitment to maintaining the stability of a nation's currency. Zimbabwe's collapse, the destructive power of uncontrolled money printing. Zimbabwe's economic collapse in the late 2000s offers another sobering example of the destructive power of hyperinflation. Like Venezuela, Zimbabwe's crisis stemmed from a combination of economic mismanagement, corruption, and a land redistribution program that decimated agricultural production. Voice 1, Roxana's voice. Faced with mounting economic woes, the Zimbabwean government turned to the printing press as a solution, flooding the economy with newly printed Zimbabwean dollars. This reckless monetary expansion triggered hyperinflation on an unimaginable scale. At its peak in 2008, Zimbabwe's inflation rate soared to an astronomical 231 million%. Prices doubled every 24 hours, rendering the Zimbabwean dollar practically worthless. People carried bags full of money to buy basic necessities, and the country's currency became a global symbol of hyperinflation's destructive power. The hyperinflation had catastrophic consequences for Zimbabwe's economy and its people. Savings were wiped out, businesses collapsed, and the country plunged into poverty and chaos. The healthcare system crumbled, unemployment soared, and life expectancy plummeted. Zimbabwe's hyperinflationary meltdown serves as a stark warning against the dangers of unchecked money printing and the importance of sound monetary policy. It underscores the fragility of fiat currencies when trust in the issuing government evaporates and the stability of the monetary system collapses.
The FIAT monetary system, while dominant, is not without its inherent contradictions. Its flexibility enables economic intervention but also creates potential for mismanagement and inflation.
Fiat adapts to changing economic circumstances, providing tools to manage inflation and respond to crises.
Unlike the gold standard, fiat's flexibility can be both beneficial and perilous. Historical examples remind us of fiat's inherent fragility.
When trust erodes or policy is mismanaged, fiat's value can plummet, leading to hardship.
Despite vulnerabilities, fiat remains dominant, underpinned by trust and regulation. The US dollar reigns as the world's reserve currency, reflecting the US economy's strength. The 21st century is witnessing a profound transformation in the landscape of money and finance. The rise of digital currencies, decentralized finance platforms, and blockchain technology is challenging the traditional roles of central banks, governments, and financial institutions.
Cryptocurrencies such as Bitcoin and Ethereum have captured the imagination of investors and technologists alike, offering a decentralized peer-to-peer alternative to traditional fiat currencies.
While still in their early stages of development, cryptocurrencies have the potential to disrupt existing financial systems and reshape how we think about money. Central banks around the world are also exploring the potential of central bank digital currencies, or CBDCs, digital versions of their fiat currencies.
CBDCs could potentially offer greater efficiency, transparency, and financial inclusion, but they also raise concerns about privacy, cybersecurity, and the potential for government overreach.
The increasing digitization of finance is blurring geographical boundaries, enabling faster and cheaper cross-border payments and facilitating financial inclusion for the unbanked. However, this interconnectedness also creates new challenges, including cybersecurity risks, regulatory arbitrage, and the potential for rapid contagion during financial crises.
Navigating this evolving landscape requires adaptability, innovation, and a willingness to embrace new technologies while also addressing the potential risks they pose.
The future of money is likely to be characterized by a hybrid system where fiat currencies coexist alongside digital currencies, CBDCs, and other financial innovations that emerge in the years to come. In a world where money is essentially a social construct, based on trust and the perceived stability of government-issued currencies, financial literacy is no longer a luxury but a necessity.
Understanding the workings of the fiat monetary system, its strengths, weaknesses, and potential risks is crucial for making informed financial decisions and navigating the complexities of the modern economy.
Financial literacy empowers individuals to make informed choices about saving, investing, borrowing, and managing their finances responsibly. It equips them to understand the impact of inflation, interest rates, and economic policies on their financial well-being.
Moreover, financial literacy fosters a more informed and engaged citizenry capable of critically evaluating economic policies, holding policymakers accountable, and advocating for a more stable and equitable financial system.
Education is key to promoting financial literacy. Governments, educational institutions, and financial institutions all have a role to play in providing accessible and comprehensive financial education programs that reach people of all ages and backgrounds.
By empowering individuals with the knowledge and skills to navigate the complexities of the fiat monetary system, we can foster a more resilient, inclusive, and financially secure society.
Financial literacy is an investment in our collective economic well-being, one that pays dividends for generations to come. The fiat monetary system, like any human-made system, is not perfect. It is a reflection of our collective choices, values, and understanding of how money should function in society.
As we move forward, it is our collective responsibility to engage in thoughtful dialogue, critical analysis, and informed decision-making to shape the future of money and finance.
The challenges facing the fiat system, from the potential for inflation and debt crises to the emergence of alternative currencies, require innovative solutions and a willingness to adapt to a rapidly changing world.
We must engage in open and honest conversations about the trade-offs inherent in different monetary systems, the role of government and central banks, and the importance of financial stability and inclusion.
The future of money is not predetermined. It is a canvas upon which we, as a global society, have the opportunity to paint a new vision, one that reflects our shared values, aspirations, and commitment to creating a more just, sustainable, and prosperous world for all.
By embracing financial literacy, fostering innovation, and engaging in constructive dialogue, we can shape a future where money serves humanity, not the other way around.
The journey ahead may be uncertain, but it is a journey we must undertake together, with a shared commitment to building a better financial future for generations to come.